Ladies and gentlemen, friends and industry colleagues from India and Germany, a very warm welcome on behalf of the Indo-German Chamber of Commerce to our knowledge session today on cross-border direct and international tax issues, India and Germany. Ladies and gentlemen, with the advent of upward trends witnessed in the last few months, it is expected that the Indo-German economic relationship would only strengthen in the times to come. As on date, we have about 1,800 German companies active in the Indian market, and most of the German investments have been focusing on sectors like automotive, chemical, pharmaceutical, construction, logistics, services, machine tools, metallurgical services, and the list goes on the understanding that the multinational companies operating today in the globalized world, they need a better understanding of the tax landscapes. And therefore, we decided to bring up this topic of cross-border direct and international tax issues, India and Germany, to all of you. And I really hope that all of you enjoy the session today. Today, our partners for the webinar is ShineWing India and ShineWing Dornbach Germany. Today, with this webinar, we aim to overall have a view of India and German tax scenario with emphasis on the tax treaty between the two countries. And our presenters today will aim to cover relevant tax treaty provisions along with the recent Indian tax jurisprudence to highlight typical issues which companies should be aware of. So it's my honor and privilege to welcome our presenters today. And our presenters today are Ms. Linda Menke from ShineWing Dornbach Germany. Very warm welcome, Linda. Hope you are all set to give us insight into the topic. So looking forward to hearing you. Linda is a senior tax advisor with the firm, having 10 years of experience in the field of tax, including tax structuring and tax advisory. And on behalf of ShineWing India, we have Mr. Atul Puri and Mr. Saurrav Sood, practice leader, direct tax, and they are senior members of the firm for international tax practice. Very warm welcome, Atul and Saurrav. We're also looking forward to hearing you. Now, both of them together have more than 20 years of experience in the field of tax, including international tax, and are regularly advising multinational companies in their tax optimization. And when it comes to litigation, we hope that no matters come to litigation, but in case there are, yes, we have some advisors right now sitting on the panel today. So they've been actively engaged in providing tax services to multinational companies engaged in real estate, renewable energy, and one of the most important sectors, the automotive sector. So we're all looking forward to hearing you, and I hand it over to you, Atul, to take the webinar session forward. And ladies and gentlemen, our audience today, we hope you enjoy this session. And of course, we will also have a question and answer session after the presentations are over. So over to you, Atul, and looking forward to listening to you. Thank you.
Thank you so much, Sonia, and thanks. Yeah, so thank you very much, Team IGCC, for giving us the opportunity to share our thoughts and experiences with respect to the cross-border direct and international tax issues between India and Germany. Before we start, I would like to put emphasis that the economic trade relations between India and Germany are very strong. Germany is India's largest trading partner in Europe, and the bilateral trade between the two countries increased to approximately $25 billion with a year-on-year growth of about 22%. Germany is also the 7th largest foreign investor in India, and its total FDI from the year 2000 to year 2020-21 has been approximately $13.5 billion. So there is a significant amount of trade relationship which is taking place, and there are very cordial relationship between the two countries. So to begin with, for today's session, as introduced, I have Mr. Saurrav Sood from our India team and Ms. Linda Menke from our Germany team will be sharing their thoughts and insights on the points for discussion. May I request for the next slide, please? Yeah, so our agenda or the index content for the discussion today includes an overview of the basic structures of entities and their taxation in India. With respect to the repatriation of funds from India, what are the withholding tax provisions? A brief understanding about some of the key articles which are applicable on the transactions between India and Germany, and what are their implications when it comes to the double taxation avoidance agreement treaty between the two countries. We will also be focusing on where we are as far as the multilateral instrument between India and Germany are concerned. Uh, some of the key sticky issues will be highlighted, which have been already part of the litigation in the past, and what has been the Indian jurisprudence on those sticky issues. Some focus area on the transfer pricing documentation and the contentious issues related to that. That's what we have gathered. Although time is obviously the limitation, and therefore it's a very detailed topic, but we have tried to cover whatever best possible in order to justify the time of all the participants in this session. Yeah. So next slide, please. So we will start primarily with the first of all with the basic structures which are prominently used in the Indian business scenario. Next slide. To begin with, we have uh, under the Companies Act, there are various options which are available. So to begin with, we have one-person company, or in short known as OPC. So under the section 262 of the Companies Act, which defines an OPC, this was introduced for smaller companies or those which are promoter driven, directly promoter driven. So in this scenario, there is only one Indian member and only one director has to be there. So these are used by generally by the promoters who basically do not want to get into too much of compliance or too much of regulatory requirement. Then the second available structure is with respect to the small companies. Small companies, there has been this has also been introduced recently under the new Companies Act, where which is not considered as a public company. The paid up capital in this case, to be a small company, to qualify as a small company, should not be more than 20 million INR. This has also undergone a change effective from 1st April 2021, which was earlier at 5 million. So the threshold for the paid up capital was 5 million, which has been increased to 20 million. Similarly, the threshold for turnover has been increased to 200 million from 20 million. So the scope for the definition of small company has been widened to include more companies into this ambit. The third possible available structure is that of a private company. So this is the most actively used as a structure by the business entities in India when they set up a business. So as we all know, private company is basically a company which is closely held by the shareholders or the members of the company. There is with respect to the basics, two members are required, and which can go up to maximum of 200 members. There is a requirement to have minimum directors of 2 directors, and there is no restriction on the minimum share capital which has to be induced. So earlier there used to be restriction on the or there used to be a threshold for the minimum share capital to be introduced. In case of a private company, there is a restriction on transfer of shares, where the shareholders cannot transfer their shares to any other third party either without the prior approval or without the consent of the members of the company. The advantage of the private company is that it has a limited liability to the extent of the amount invested by the shareholders. So that's why it has been the most active structure which is being used by the business houses in India. Next option is related to the public company, where the public companies are basically listed on the stock exchange, and the threshold for the basic thresholds are for requires minimum 7 members and minimum 3 directors. There are restrictions on the remunerations which are paid to the directors. So there is a rule which has been defined, and according to the rule, the remuneration are restricted to a certain extent. but there is no restriction on the transfer of the shares in this case. Then we have Section 8 company, which is primarily for the purpose of charitable objectives, where the profits are not where the generation of profit is not the primary objective of the members of that company. So these are under the Companies Act. These are some of the major structures which are prominently used. Then we also have a hybrid model of organization which was introduced in the year 2008, known as limited liability partnership. So yeah, first we need to understand why there was a need of limited liability partnership. If we go to the primitive partnership model, there were a lot of restrictions or limitations in that, because although it gave the flexibility to the partners for operating the business, however, the biggest flaw was that it had unlimited liability of the partners. So this means if there is any kind of liability which comes on the partnership firm, it may confiscate the personal properties of the partners as well. So it did not, the primitive or the traditional partnership firm did not have the flavor of a private limited company. That is why in the year 2008, the Limited Liability Partnership Act was enacted, and it gave birth to a hybrid organization known as LLP. LLPs, basically there is a minimum requirement to have two partners, with at least one partner being resident of India. Uh, it is as I said, it is a hybrid kind of an organization which gives the flexibility to do business at the option of the partners, and it also restricts the liability of the partners to the extent of the contribution which they have done in the LLP. It also allows flexibility to obtain ECB, external commercial borrowings, and even the foreign nationals or NRIs can do an investment in these kind of structures. So that is why LLP is considered as a new hybrid model for creation of business entities in India. Then we also have certain options such as liaison office, branch office, and project offices, which are used very actively by the foreign companies. So liaison office, as the word suggests, it is an office that facilitates close working relationship between the parent company situated abroad and the business parties in India. So the liaison office is also known as a representative office, and the liaison office has certain restrictions where they cannot undertake certain business activities in India, and they cannot also earn any income in India. However, the activities which liaison office can undertake includes representing. Some of the examples are like they can represent a foreign company in India, they can promote the export or import to India, encourage technical financial collaborations between parent or group companies, and also act as a communication channel between the parent company and the Indian company. Then with respect to the branch offices, so a branch office actually mirrors the function of a parent company. The offices, this kind of branch offices are established to perform similar business operations as the foreign parent company at different locations in India. So branch offices can carry on substantially the same business as the parent company. They can carry out all the trading activities that a parent company does. So the major restriction being carrying out manufacturing activities through the can also be subcontracted to the Indian manufacturers. Uh, so branch office can basically provide all kind of professional or consultancy services, can promote export or import from and to India, and also represent the company in India as acting as an agent for trading or manufacturing of their products in India. So branch office, we will discuss about the taxation of these kind of line office, project office, and branch office separately. But coming next to the project office, so project office basically is incorporated when there is a specific contract or a project in hand, so which has been allocated to a foreign company under the approval of RBI. So the project office can only undertake the activity which is related to the project which has been allocated to that company. The primary condition for opening a project office in India is that the parent company must have secured a contract. So that is the primary criteria basis which a project office can be created. The entire financing of the project office has to be done by the parent company in the given scenario. Yeah, next slide, please. So now talking about the basic structures of entities and then their taxation. So basically, if you talk about the taxation around the corporate side for the company which we have discussed, primarily the tax rates vary between the range of 22 to 30% due for different kind of provisions and sections. So if I divide them into further three sections in the table below, as you can see, and let's discuss one by one and what are the nitty-gritties which are involved into it and how a company can, what is the factors basis which you can decide which under which rate should we fall or should we qualify. So my first line item, which is section 115 BA, regarding domestic manufacturing companies. So domestic manufacturing companies can opt for the beneficial rate of 25%, provided they follow or they qualify certain preconditions which are defined. So in this case, if I talk about section 115 BA, this was basically introduced from and was made effective from financial year 2016-17. This was applicable to companies which were incorporated on or after 1st of March 2016, right, and was specifically applicable only to those companies who were engaged in the business of manufacturing or production of goods and articles. So it was not applicable, this option was not given to the trading companies. Now there were certain specified exclusions in this case, and these exclusions are applicable to the other two sections as well. So when I go to the next two provisions, you will see that it prevails in those scenarios also. So what are these specific exclusions in this case? That it will be deemed, so when you're computing your total income will not be adjusted with any additional depreciation which is otherwise eligible to you under the provisions of section 32 2A of the Income Tax Act. And also you will not be eligible for any kind of additional deductions or benefits which are being imparted by the Income Tax Act for making any additional investment in the new plant and machinery with under which qualifies under various sections. So I'm not going into the detail of those various sections. uh, then the second point which will not be included over here is the carry forward losses which are related to these deductions and claims. So any carry forward loss is which is because of such claims or deductions, as mentioned in my first point, which is related to the additional depreciation and additional incentives which are given to the company. If the carry forward loss includes those losses, then that will also not be allowed to be deducted from the total income of the company while computing the taxable income. So in this case, these were the primary two conditions. So if you have to run the numbers and do the mathematics. So if you are able to finalize or identify that your total income does not have any major impact because of these criteria or specified conditions, then probably it is ideal to opt for the reduced or the beneficial rate of taxation. Uh, there is another requirement over here which says that your turnover in the year previous to the in the previous year to the financial year should not exceed 400 crores. So like if we are estimating or the taxable rate for the financial year 2021, then the turnover in the 1 year previous to the previous financial year, that is 2019-20, should not exceed 400 crores. So these are the primary conditions which are applicable for section 115B. Also to mention that once this option has been exercised by the company, then there is no possibility to take a U-turn. So once you opted for the beneficial rate under section 115BA, then you need to continue with the same provision and follow them. Next is related to section 115BAA, which was basically introduced from financial year 1920 for certain specified domestic companies, where the beneficial rate was reduced to further to 22%. Now, what were the specified conditions, or what are the specified conditions which are to be followed in order to avail the benefit of the reduced tax rate. Primarily, the conditions remain same as we discussed in section 115BA. However, there is one more condition introduced over here, that in case due to any scheme of demerger or amalgamation, if there are certain losses which are introduced into the SECI company, which were otherwise which have arisen due to the above factors, like additional depreciation or incentives or whatever we have discussed earlier, then they will also not be allowed to be deducted from the total income in order to apply the beneficial rate of 22%. Here also, once the option has been exercised, then you do not have the option to take a U-turn. So if you have opted for section 115BAA, then you need to follow this religiously and continue with the same tax rate for the future years as well. Now we go to the third corporate tax rate, which has also been introduced from effective from 1st April 2019, which was basically for new domestic manufacturing companies. Here the rate has been further reduced to 15%, and the primary conditions in this case, in case of section 115BAB, was that the business is not formed by splitting up or reconstruction of the business which is already into existence. That is condition number one. Then condition number two, the company should have come into existence or should have been incorporated on or after 1st day of October 2019, and the company should have commenced manufacturing or production of goods and articles on or before 31st March 2023. So this is the timeline which has been defined in order to qualify for the reduced beneficial rate of 15% for your corporate tax. In addition to this, the other conditions which we have discussed in the previous section, which is 115BAA, remains the same. There is no specific addition to that. However, there are certain manufacturing activities which have been excluded from the provision. So the manufacturing has been specifically defined, but then under the provisions of Income Tax Act, but there are certain manufacturing activities which have been specifically excluded and will not be considered for the purpose of this beneficial rate of tax under the Income Tax Act. So these include like development of computer softwares, mining, conversion of marble blocks, bottling of gas into cylinder, printing of books, or any other business as may be notified by the central government from time to time. So these are some of the sectors which have been specifically excluded from the ambit of section 115BAB, who cannot adopt the beneficial rate of 15%. The other specified conditions, exclusions related to additional depreciation and special incentives are applicable in this case also. Your allowance, in case of allowance of carry forward loss, if it includes anything related to the additional depreciation, again applicable over here, and any loss which is carry forward pursuant to scheme of demerger or amalgamation will also be religiously followed over here. Then in this case, also if you have followed the if you have adopted this section, then you need to follow this section. However, due to some reason, if you get disqualified, then you still have the option to go back to section 115BAA. So if due to any circumstantial changes in future, you do not qualify these conditions which are predefined under section 115BAB, then you can still go to 115BAA and follow the rate of 22% as your corporate tax. In addition, your MAT, which is the minimum alternate tax under section 115BJ, will not be applicable in the case of the last two sections where 22% and 15% has been mentioned. So if you qualify any of these two sections, or you opt to adopt any of these two sections, then minimum alternate tax will not be applicable in that scenario. You will be out of that ambit. So you need to run your mathematics before you take a decision that whether you have any accumulated business losses other than those which have been specifically excluded for setting off against the total income. In that case, it is beneficial to adopt the new regimes which have been introduced from financial year 1920 onwards. Yeah, next slide, please. Okay, so with respect to the withholding tax provisions, next slide. For repatriation of cash from India, there are options, more options also available, but I will be focusing primarily on dividend payment by the shareholders, by an Indian company to the shareholders, and buyback of shares by a Indian company. So let's go back first to the provisions when the dividend was not subject to withholding tax. So what uh, earlier, prior to, you can say, 1st April 2020, dividend was subject to dividend distribution tax, and the tax was to be levied by the company who is declaring the dividend and was to be paid to the government under the provisions of section 115O. This dividend, once paid to the shareholder, was exempt in the hands of the shareholder under section 10 subsection 34 of the Income Tax Act. So this was effective till 31st March 2020. However, post amendment from 1st April 2020, the dividend was made taxable in the hands of the shareholder itself. So now it was the shareholder himself. The onus was put on the shareholder to pay the taxes on it. So now, if we talk about the taxation of the dividend in the hands of the shareholder, let me divide this into two categories. One is a resident shareholder, and the second is a non-resident shareholder. So in case of a resident shareholder, it will fall under the provisions of section 194 of the Income Tax Act. So in that scenario, the TDS or the withholding tax will be levied at the rate of 10%. I am assuming that the shareholder is able to provide the PAN number. But in case the PAN number is not available, then there is a generic provision under section 206CC, where if the permanent account number is not provided by the shareholder or the assessee, then whatever is the effective rate, it will be the rate will become double from what the effective rate is. So let's come back to the same discussion which we were having, that in case of a resident shareholder, the dividend will be subject to withholding tax of 10%. Surcharge on health and education cess are applicable as per the income slab, so I'm not focusing on that. Now coming back to the non-resident shareholder. So in case of a non-resident shareholder, the provisions under the Income Tax Act are defined under section 195, and there is an arbitrage which is available under the article 10 of the DTAA, Double Taxation Avoidance Agreement, between India and Germany. So in order to qualify and avail the beneficial rate of 10%, the shareholder, the foreign shareholder, has to provide certain documents in the form of tax residency certificate from the German tax authorities, and no PE, no permanent establishment certificate in form 10F, declaring that they do not have a permanent establishment in India, or a PAN number. So if a permanent account number is also available, that also has to be provided by the foreign national. In that case, they can avail the beneficial rate of 10% for the taxation of dividends. So the concept now is that the onus is on the shareholder to, when they receive the income, they have to declare that as a taxable income. The company who is declaring the dividend has to withhold tax depending on whether it is a resident shareholder or a foreign shareholder. If it is a resident shareholder, then it will be 10%, and if it is a foreign shareholder, then it will be 10% or 20%, as the case may be, depending on the documents which they provide. So that is all about the withholding tax provisions on dividend. Next is buyback. So this is another option available for repatriation, where Indian company or Indian company decides to buy back the shares from its own shareholders. In that case, the keeping aside the provisions of Companies Act, because there are certain restrictions, rules which have been defined under the Companies Act, that how much and how you can buy back, not focusing on that. So there is, under the Income Tax Act, whatever is the sale consideration which is decided in accordance with the Rule 11 US. So here also you need to do the valuation of the shares, and basis that the sale consideration or the fair market value is decided. So the difference between the fair market value and the original paid up value, which is the amount distributed as income by the company to the shareholders, will be subject to a withholding tax of 20%. Once this 20% is deducted and paid to the government, then the entire distributed income becomes exempt in the hands of the shareholder. So the buyback tax, once is deducted and deposited, then there is no tax which is payable. However, that is 20% plus surcharge and health and education cess is a cost which has to be included while you do the calculations, or while the company does the calculation, that how much has to be repatriated and what will be the tax incidence in that case. So this is all about buyback tax. I would like to ask my colleague Linda over here, that Linda, if we have going back to this buyback tax provision in India, where 20% taxes are deducted. So what is your view or opinion on that? That whether this tax deducted will be available for a credit, as tax credit in Germany?
Yeah, thank you, Atul. Actually, this is a really tricky question because there are some requirements for foreign taxes to be credited in Germany. So foreign taxes in Germany can only be credited if they correspond to a German income tax. In addition, the taxpayer must provide proof that the tax was charged to him and that he paid it abroad himself. So the Indian buyback tax is probably most likely not a creditable tax corresponding to German income tax. Also, taxes are charged to and paid by the Indian company. So therefore, in most cases, a credit will probably not be applicable in Germany. However, each case should be rated individually.
Yeah, so there is, you mean to say there is subjectivity linked to it, whether the credit will be available or not, and there are certain compliances which are to be done, basis which we can consider that the tax credit will be available in Germany.
Right.
Okay, thank you, thank you. Next slide, please. Yeah, so now coming back to the taxation of the of certain income which is to be paid, which will be discussed in detail in the article clauses of the DTAA, which my colleague Linda will be explaining more. Like for dividend, we have already discussed, which will be, if we follow the DTAA rate, then it will be taxable at 10%. And under the domestic income tax provisions, it will be 10% with PAN and 20% without PAN. Similarly, interest, if paid on any kind of debentures, loan, ECB, it will be under the DTAA taxable at 10%. However, under the domestic provisions, for ECB, beneficial rate of 5% is available, and 10% with PAN other than ECB, and 20% without PAN. Royalty and fee for technical services, as defined, we will have more discussion in detail as part of the treaty clauses when we discuss. However, there is no arbitrage which is available as far as the tax rates are concerned. So the domestic tax rate and the DTAA tax rates are parallel to each other, and there is no beneficial rate which has been provided under these two articles as well. So that's about the structures and the tax rates which are available for the companies who have incorporated businesses in India or intend to incorporate business in India. From here, I would request my colleague Linda to come take the dais and share her thoughts on the DTAA between India and Germany.
Yeah, thank you. So next slide, please. So once again, very welcome from me as well. I will take you through a quick ride through the double taxation avoidance agreement, and well, I hope you have an interesting session here. Next slide, please. So first of all, I would like to give you an overview on the tax liability from the German perspective. So in Germany, you can either be unlimited tax liable or limited tax liable. The unlimited tax liability is reached when either your head office or your place of management is located in Germany. Now, remember that the existence of only one of these factors already leads to unlimited tax liability in Germany. What happens when you are unlimited tax liable in Germany is that your world income is included in the German taxation. So even if your company is active in a foreign country, for example, with a permanent establishment, the foreign income will be subject to tax in Germany at first. Limited tax liability, on the other hand, means that neither your head office nor your place of management is located in Germany. However, you may still be able to generate income that is considered domestic income, which will then be subject to tax in Germany. Now, imagine both situations from a firm perspective, which will possibly have the same categories. Dealing in more than one country may always lead to a double taxation issue, and we will be talking about this, how this can occur very shortly. Saurrav, does India also have a territorial rule of taxation for non-resident companies?
Yeah, so Linda, just taking it from an India perspective, when I see the Indian taxation for a non-resident company, so they generally follow the rule of nexus. So in India, if a non-resident company is to be taxed, it is the income that is related to the Indian activities that will be only taxed in India. Any income other than the Indian activities will not be offered to tax in India. So this is what we call the territorial rule of taxation in India, where you are next with the Indian activities and limited to that, the non-resident is supposed to offer that income taxable in India.
Okay, yeah, so that's pretty similar, I would suppose. Next slide, please. Okay, so let's have a closer look on the place of management here and start off with some examples. The first example is vital for your first step in engaging your business with another country. Imagine your corporation is currently located in Germany, so you are unlimited tax liable in Germany. In this example, the management moves to a foreign country, but the corporation is still located in Germany. Often, the relocation of the management goes hand in hand with the relocation of assets. Assets that will move to a foreign country will then be restricted from the taxation in Germany. Therefore, German law provides a fictitious disposal of these assets at fair value. That means all hidden reserves will be raised and taxed. This is something that you want to keep in mind when engaging with whatever foreign country. Saurrav, how about India? Does India have similar rules to counter this kind of tax planning?
So generally in India, when I say the place of management is outside and the assets are generally moved along, that is not that we have often seen. But what we are seeing of late in the tax structures is that some of the assets like the intellectual property right assets, etc., are generally kept at a low tax jurisdiction. When these assets are kept, the Indian operating company pays certain royalty payments to these access rights to the IP, which is a repatriation of profits from the India company to the outside company. Now, though India has a SAR provision, that is specific anti-avoidance rules in terms of transfer pricing mechanism, India also has GAR, that is a general anti-avoidance rules. But when we read them together, the transfer pricing principles read with the domestic tax laws makes the payment, that is any payment made to a foreign company, as a subjective payment. So you have the tax authorities are very cautious in understanding the value that the company is receiving for the monies being paid, either through the transfer pricing provisions or through the effective services that are being provided for. And we have seen recently as well as in the past that where the sums are paid without actual services or any asset rights received, such payments have been standing to be disallowed to the Indian company as a reduction of expenses.
Interesting. Yeah. Thank you. Next slide, please. Okay, so the next two examples will show you how the risk of double taxation may arise. In the first example, the corporation has its head office in Germany, whereas the place of management is located in a foreign country, for example, here in India. This leads to an unlimited tax liability in Germany, which means that the corporation's world income, so including the foreign income, will be taxed in Germany. Now, having its place of management in a foreign country will most probably result into an unlimited tax liability abroad, which means with the corresponding tax regulation, the corporation will also be treated unlimited tax liable abroad, and the foreign country would tax the corporation's world income as well. This leads to a risk of double taxation. India and Germany, however, have agreed on double taxation avoidance agreement, or DTAA, which prevents the risk of double taxation. We will have a closer look on the double taxation agreement later. Saurrav, one more question to India. Does India also have a similar place of management rule here?
So in India, there is a concept which was introduced in 2016 called the place of effective management. So generally what it says is that the place of effective management is distinguished from a place of management. So you may have a multiple place of management, but you may have one single place of effective management. So what the rules say is that where the brain of the company, where the key decisions are taken. That is considered as a place from where the business is being managed. Now, these are something which have been incorporated with the perspective of which are akin to the CFC control foreign company rules. So, if I see an Indian company having a subsidiary outside, and that subsidiary is effectively managed from India by the same board of management. So until and unless you are able to prove otherwise, the substance and form is taken into consideration, and where the decisions of the subsidiary are taken by having a board of seat in India itself. In such cases, the taxable profits of the subsidiary will be attributed to the Indian company and the taxes will be paid therein. Now, what you mentioned in this slide is that there is a double taxation avoidance agreement in place, which will take care of such double taxations. Now, what happens in this case is where a POEM rule, that is commonly called a place of effective management rule that we say it as, comes into trigger, it generally does not consider such foreign company as a company which is eligible to a double taxation benefit. Now, once that benefit is taken over, that means the provisions of DTAA double will not apply, and therefore the foreign tax rate for the for the foreign company for taxes paid in India may not be available as such. Therefore, this becomes a whole Pandora box where the effective management is outside India, whereas the company is technically a non-resident company but is having a controlled operations through India.
Okay, yeah, so you really have to be careful when engaging between Germany and India, I guess.
Yes, absolutely.
Next slide, please. So in this example, the risk of double taxation is not faced because of a double unlimited tax liability, but because of a collision of unlimited tax liability in one country, here in Germany, and a limited liability in another country, for example, India. The corporation in this example has its head office and place of management in Germany. As we learned before, this leads to an unlimited tax liability in Germany. Imagine the corporation now sets up a permanent establishment abroad. Don't worry, we will take a closer look at what may be seen as a permanent establishment in a second. So the permanent establishment engages its business activities abroad and is therefore limited tax liable with its foreign income from the permanent establishment. However, as the corporation is unlimited tax liable in Germany, remember that Germany taxes world income and therefore including the foreign income. As you can see, the corporation is facing a risk of double taxation, which again will be prevented by the DTAA. Next slide, please. So before we get into the depth of the DTAA, let us have a look at some forms of foreign engagement. As the form of foreign engagement is always measured from local perspective, we have included a comparison for you on the definition in the tax treaty and in German law. So the quickest and easiest way to do business abroad is through a permanent establishment. A permanent establishment can be actively established, but it can also come into being by mere action. Therefore, caution is required if the existence of a permanent establishment is to be prevented when operating abroad. According to the definition of the DTAA, a permanent establishment is a fixed place of business through which the business of an enterprise is wholly or partly carried on. Also, the taxpayer shall have the power to dispose of the business facility or plant. The definition in German law is very close to this. According to this, a permanent establishment is any fixed place of business or plant serving the activities of an enterprise. Also, according to German law, the taxpayer shall have the power to dispose of the business facility or plant. As a rule, the definition in German law is to be interpreted much more broadly than the definition in the double taxation agreement. We have listed some examples of permanent establishment on the slide. As a rule, the place of management, an office or warehouse are permanent establishments. However, there may be also differences between the various laws, as can be seen here in the case of permanent deputy. In Germany, no permanent establishment is considered in this case, while the double taxation agreement also considers the permanent deputy as a permanent establishment. This may lead to some difficulties in local taxation. Saurrav, what are the broader criteria for a permanent establishment that India follows?
So Linda, if I see the definition from a treaty perspective that you have just highlighted in a column, I think that the definition, the criteria to consider a presence as a permanent establishment remains the same, just that India follows a UN model convention. There's also a service fee that India generally has in its treaties negotiated. Now, when I come to the domestic law, what I see is your treaty definition and the German definition is more or less aligned. However, when I see India's case, India doesn't have a definition of a permanent establishment, but it has something which is different from permanent establishment called a business connection. So when I see business connection is a very, very broader term that is used in the domestic tax provisions. Uh, so there has been a lot of jurisprudence, there has been a lot of debate on what constitutes a business connection. A standalone transaction has also been included. A recurring transaction has also been included. A habitual negotiations to conclude a contract has also will also fall under the definition of business connection. Just that India has always been a step ahead in terms of adapting the global principles. The BEPS Action Plan 7, where it recommends certain principles on the habitually concluded contract or participation in habitually concluding a contract, is also termed as a permanent establishment going forward. The same principles have been enshrined under the domestic tax law under the definition of business connection. Now, what happens is where a treaty which is there with India is also governed by the provisions of MLI, which is a multilateral instrument, which we'll be dealing subsequently. The definition under the domestic tax law as well as the definition of P under the renegotiated synthesized text of a treaty, if it aligns, the scope of P has been significantly enhanced. Where earlier fragmented transactions were excluded from the permanent establishment, now forms a part of a permanent establishment to be created in India. So even if you have a split contracts, even if you have a contracts under different categories, just to avoid prep and auxiliary activity from the PE perspective, still, if at all the treaty is amended by the synthesized text, that is by through the MLI, the act provides the same to be taxed, otherwise will now be held as a permanent establishment in India.
Okay, well, thank you for that overview. Next slide, please. So instead of a permanent establishment, there's always the possibility to establish a company abroad. Atul has mentioned in the beginning what kind of entities would be applicable for this in India. Generally, a partnership and a corporation come into consideration. Those are covered by the double tax agreement. Again, there may be deviations due to the respective definition of partnership and corporation. Under German law, the legal form does not depend on its treatment abroad. Rather, the foreign legal form must be analyzed on the basis of various criteria and is then assigned to one of the legal forms in accordance with German requirements. This therefore results in the so-called type comparison. The Federal Ministry of Finance in Germany has already published a list of foreign company forms and their classification. So this can be checked in advance to be sure when choosing legal form abroad. Next slide, please. We will have a look on the double taxation avoidance agreement now. Next slide, please. So what exactly is a double taxation avoidance agreement and what does it do for German and Indian corporations? This agreement itself has already been signed by both countries in 1996, so it's not really something new. We already learned that the DTAA prevents the risk of taxing the same income in more than one country, but it can be applied only if the personal scope is given. For this, the corporation needs to be a resident of one or both of the contracting states, so Germany and or India. This means that either head office or place of management needs to be in one state. The agreement is not applicable if the corporation is only limited tax liable in one or both countries. Taxes covered from the double tax agreement are especially income tax, corporation tax, and trade tax. In the following, I would like to go through the major topics of the DTAA that might be of your interest. Next slide, please. So let's start off with Article 6. Article 6 of the agreement deals with immovable property. Imagine your company is located in Germany, but owns real estate in India, from which it also generates income. In Germany, the company's world income is subject to taxes, so including the income from the Indian real estate. However, India will also subject this income to Indian taxation under local law. This leads to double taxation. The double taxation agreement ensures that the right for taxation is only assigned to one state. In the case of income from immovable property, the state in which the immovable property is located is entitled to levy taxes. So in our example, India is assigned the right to tax in order to avoid the double taxation. Germany, however, does therefore not include this income in their taxable income. However, Germany has the right to include the income to determine the tax rate. This is called a progression proviso. The progression proviso is only applicable on sole proprietorships and partnerships. So the progression proviso does not apply for corporations because the corporate income tax rate in Germany is set at 15% by law. Next slide, please. Article 7 is probably more relevant to you because it regulates the taxation of corporate profits. In our example, the company is again located in Germany. This time it has a permanent establishment in India. So we just already talked about what a permanent establishment is, but let's just quickly refresh. A permanent establishment can, for example, be a place of management or a branch, an office, a factory, a workshop, a warehouse, sales outlet, building site, or construction. In Germany, the company is again subject to taxation on its world income. The permanent establishment, on the other hand, will have to pay taxes on its income in India. In this case, the agreement stipulates that corporate profits should be taxed in the state in which the business is carried out by the permanent establishment. It is therefore necessary to divide and allocate the income to the permanent establishment. This can sometimes lead to some difficulties, so precautions should be taken from the very first beginning of the establishment, for example, by implementing a separate bookkeeping. Next slide, please. Corporate profits from the permanent establishments are excluded from taxation in Germany. For companies that are not corporations, the progression proviso applies again. However, keep an eye on the activity clause in Article 23. Accordingly, corporate profits are only exempt from taxation in Germany if they perform so-called active operations. Active operations include the manufacture and the sale of goods or merchandise, technical advice and engineering services, as well as banking and insurance business. The company must provide evidence of its active operations. If there are no active operations, the crediting procedure applies instead of the exemption procedure. This means that the company's profits are included in the taxation in Germany and the tax paid in India is offset against the German tax. Next slide, please. Article 9 of the agreement is applicable for corrections of income between associated companies. So just like Article 7 before, Article 9 is also relevant for the allocation of income. However, instead of an allocation according to the reason, Article 9 allocates income according to the amount. So that means Article 9 implements the dealing at arm's length principle. This indicates that corporate profits should be taxed where they arise economically. So attention here, the application of Article 9 may also result in a double taxation instead of preventing it. This is the case when one country corrects the taxable income, for example, during a tax audit, whereas the other country does not. So usually when you look at double taxation sample agreements, it provides a second paragraph that requires the other state to make an equivalent correction. But the German-Indian agreement does not include this paragraph, which means that an equal correction is not mandatory. Even greater attention should therefore be paid to the determination, the design, and the documentation of transfer prices in order to avoid this kind of double taxation. So this is why we also have a look on the transfer pricing documentation requirements later on. Next slide, please. Article 10 deals with the issue of dividends. In our example, an Indian corporation pays a dividend to its German shareholder. According to the agreement, the right to tax is assigned to the recipient country, for example, here in Germany. However, the distributing country may also withhold taxes of up to 10%. But Article 10 only applies if the dividend paid is not attributable to a permanent establishment of the German company, which is located in India. If this would be the case, then the income would be defined in another article, for example, Article 7 that we just discussed before. Double taxation in this case is avoided through exemption from German tax. However, special requirements are attached to this. Accordingly, only those dividends are exempted where the recipient is a corporate based in Germany that holds at least 10% of the shares in the Indian company. In addition, the distributing company must be located in India. In all other cases, double taxation is avoided by offsetting the foreign tax against the German tax. This applies in particular to partnerships or natural persons located in Germany, to free float of less than 10%, or in cases of non-compliance with the activity clause. Next slide, please. So Article 11 of the agreement deals with interest. As Article 12 for royalties is very similar, we have summarized it here on this slide. Article 12 also includes fees for technical services, which means all kinds of payment for services in managerial, technical, or consultancy nature, including services by technical or other personnel. The main concept is not much different to dividends, so we will just go through here very quickly. Generally, the recipient state has the right to tax. Again, this rule only applies if the interest is not received by a permanent establishment in India. A tax of up to 10% may be withheld. Atul has already mentioned this before. However, instead of an exemption of interest from the taxable income, double taxation for interest income is prevented by crediting the paid taxes against the German tax. Please don't forget the proof. Next slide, please. So the last article that we will cover today is Article 13. It deals with capital gains. That means gains from the sale of immovable property, movable property if it belongs to business assets of a permanent establishment, or shares in corporations. According to the agreement, the right to tax is assigned to the country where the property or the corporation is located. Capital gains are exempt from German taxation. Next slide, please. Okay, so besides
one question, I'm sorry to just interject. Just one question out of curiosity. When you say capital gains are exempt under the German taxation, so in that case, any taxes that have been withheld in India on any share transfer or any asset transfer which have a nexus with India, that means that credit of taxes will not be available in Germany in that case, if the capital gains are exempt.
If it's exempt from the German tax, it means that it's not included in the German taxable income. So there's no question about crediting or deducting the taxes paid in India, because we don't even pay taxes in Germany on it.
Okay.
All right. So we talked a lot about the DTAA, but besides the DTAA, there's a new instrument that has been established just recently for international taxation matters. This is the multilateral instrument, or MLI. Next slide, please. The MLI is a result of action item 15 of the base erosion and profit shifting project of the OECD. This is to adjust double taxation agreements worldwide in the short term. The MLI offers concrete solutions for governments to close gaps in existing international tax rules by transposing results from the BEPS project into bilateral tax treaties. It modifies the application of thousands of bilateral tax treaties, including concluded to eliminate double taxation, and it implements agreed minimum standards to counter treaty abuse and to improve dispute resolution mechanisms. But it's still there to provide more flexibility to accommodate specific tax treaty policies. So implementing the MLI for a country does not mean that the existing double taxation avoidance agreement is not longer valid. In fact, both agreements coexist. However, a signed MLI will always have priority to the double taxation avoidance agreement. The MLI does not have to apply to every existing DTAA right away. Instead, treaty partners can specify the treaties which they wish to see covered by the MLI. This is the so-called covered tax agreements, or CTA. The former double taxation agreement will only be modified by the MLI if both treaty partners have listed as to be covered. So looking at India and Germany, both countries have already signed the MLI. However, whereas India has included Germany as a covered tax agreement, Germany has not yet included India. So that means that the MLI is not yet applicable for the Germany-India tax treaty. And also, it is unclear whether Germany will consider India in the MLI in the near future.
Right. Linda, in that case, just a question to you, quick question to you, where India and Germany tax treaty is still not yet covered by the provisions of MLI. That means the preamble remains the same that it was at the time of negotiation entering into force, and the articles are to be read as it is. Does Germany have any domestic provisions under which the tax abusive or the tax optimized structures can be otherwise brought to tax, which are escaping the provisions of tax, if not through the treaty provisions, but through the local laws? Like India has GAR, India has SAR. India is pretty active in terms of implementing such provisions. What about Germany in that case? Linda, I think you're mute.
Yes, actually, in fact, there are sorry, I think I have some sound issues currently. I think you just asked if there are local laws that prevent tax abuse. So yes, in fact, there are national laws in Germany that that tax the income of so-called intermediate companies that had neither their registered office nor their management in Germany. And the shareholders will be taxed in this case. So yes, there are local laws. So that means that even if the MLI is currently not applicable, there's still some national regulation that prevent an abuse.
Fair. Thank you. Thank you.
You're welcome. Okay, next slide then.
Yeah, I think I'll take it over from here from you, Linda. Thank you so much for your presentation. So
Thank you.
as at the starting, Sonia said that there should not be chances of litigation when it comes to advising. Definitely, that is an ideal scenario that everybody expects. But as we all know, that tax authorities worldwide are aggressive, and Indian tax authorities are definitely aggressive when it comes to certain provisions to be implemented. So therefore, there are a lot of issues that we see of late on the interpretation of the international tax provisions. And we just thought we just compile few burning issues that should be to the knowledge and awareness of everybody, that those who are taking time out to attend this session. Can you have the next slide, please? So these are the certain rulings on the international tax which deals with the provisions of treaty that we have compiled. So there are certain rulings which deal with the India-Germany treaty, and certain rulings which are otherwise but have a bearing on the treaty interpretations definitely. So when I see the first ruling which deals with the project office P, so there's this judgment of the Supreme Court in case of Samsung Heavy Industries, in which the court very clearly interpreted that the project office will not always be an office to be taxed. In this case, the project office, there was a twin presence of the presence in India. One was in the way of a subsidiary in India, which was the operating company, and the other was through a project office. The project office was limited to only doing the preparatory and auxiliary activity, and those activities were limited to liaising between the foreign company and the Indian subsidiary. Therefore, while nothing was attributed in terms of the business or the income to such project office, the tax authority still held that the project office is nothing but an extension of the foreign company in India. To which the Supreme Court categorically held that preparatory and auxiliary activities will not are covered under the provisions of exception of Article 5 in case of an India-Korea treaty, and therefore it was held as not taxable in this case. Now, what happens when I read this case vis-a-vis a fixed PSP? So project office being a prep or auxiliary presence is still covered under Article 5(4)(e) of the India-Korea Treaty. Whereas in case of a MasterCard, which is a very famous judgment that we have of late seen, which is still in the Indian courts and yet to be adjudicated beyond the AR, we read a detailed judgment of MasterCard in case issued by the Advanced Ruling Authority, where the Revenue Department had a very feather in the cap in terms of getting a favorable judgment. While we read the judgments, there were a couple of issues that we thought we should bring to knowledge. These are the issues which will be debated, which will be often brought across while these structures are being implemented in terms of the international presence in India. So in MasterCard, there were primarily three kind of transactions which were held as a presence of the foreign company in India. One was through the presence of the employees, though employees were taken as performing services on behalf of the parent entity, that is a foreign company. The second was MasterCard India was held as a dependent agent for acting on for and on behalf of its parent entity. And the third was that the interface processor and the network that MasterCard has in India was itself held as a fixed PSP for the purposes of taxation. Now, department, what the revenue authorities did was they tried to tax it from all the angles. The AR was in agreement to the contentions of the revenue authorities. The matter was decided against the SSC, and the matter is still pending before the Delhi High Court. But what we understand from the final print is that while any business structures, while any transactions are being implemented, there has to be very clear documentation that needs to be present. The documents should specify the functions and the assets to be functions to be performed, assets to be deployed in terms of performing those functions, and therefore the papers and the documentation should speak in itself. Where the transactions are crisscrossing each other, the transactions are not clear in terms of who to perform what, there are always chances that the department will always take these transactions with a gray area, and therefore the adverse tax provisions may kick in, and the transaction may be held as taxable, and this ultimately will lead to litigation which has to be taken care of there and then. Now moving from MasterCard judgment, which has its own peculiarity, which tells us the importance of documentation, there is a ruling in case of a Formula 1. Now, Formula 1 ruling was decided by the apex court. What held in the Formula 1 ruling was very clearly that the disposal test was the test which was debated under the Formula 1 ruling. Now, what exactly is a disposal test in terms of Article 5? So the SSC had its contention that its presence in India was limited to a number of days. Those number of days are well beyond the threshold limit, which is otherwise not provided under fixed PSP, and therefore such limited presence in India will not constitute a fixed place in India. To which the court very categorically implemented that fixed place is not dependent on the number of days presence. Fixed place is dependent on the disposal of the place where the functions are being performed or the activities are being undertaken. Depending upon the nature of activity, it can be said that even a single day presence basis the nature of activity shall constitute a fixed place if that place is available at the disposal of the SSC. Now to this, the court held that because of your peculiar nature of business that you are doing in India, your presence of 6 to 7 or 7 to 8 days in India is sufficient enough for you to undertake your activity and conclude activity. Therefore, in spite of being a limited presence, that presence was sufficient enough to satisfy the disposal test. Hence, in this case, the PE was held to be present in India. Now, what do we take as a learning from this? So we say that when you see a permanent establishment under the present interpretative scenarios that has emerged over the period of time, we have to be sure that the presence of any foreign company employees, presence of employees at a particular place, presence taking a place at its disposal, has to be carefully analyzed, where the requirement of without being at a specific place, the work can be still undertaken. That needs to be an option to be explored. Bringing offshore employees onshore in India, exposing the entity to a PE exposure is not something that should be taken. That should be ideally done. Where we envisage that the employees are to be placed into India, there should be an exploitation of a deputation or secondment agreement so that the foreign company does not become subject to tax in India, and it is only the income of those the foreign employees that is offered to tax in India under the domestic tax provisions. Next slide, please. Now, moving from the tax jurisprudence, which was otherwise, now I'm dealing with the specific India-Germany DTAA jurisprudence. When I see the first case, which is the case of Audi AG, in this, what the ITAT held was that a principal-to-principal transaction in terms of a sale transaction shall not constitute a permanent establishment in India, hence no profits can be attributed. Now, what do we learn from this ruling? What we say is that where a foreign company is engaged in sale of products, and that sale of products is done, of course, subject to transfer pricing provisions, is done to its subsidiary in India, and there is nothing beyond the sale that has happened as an activity in India, the foreign company can always take a position that the profits from the activity of sale shall not be attributed to India. Therefore, nothing will be taxable in such case, and this will not constitute a permanent establishment because of its limited activities in India. Now, moving on from that, we also see the cases where the employees which have been deputed in India for a specific period leads to certain adverse tax provisions. Now, what we often see in these cases is that the foreign employees come on a short duration to India. Such short duration triggers certain personal tax liabilities on the foreign company while paying the salary outside India, but the employees are working in India. If those employees become a taxable resident in India because of their number of days presence exceeding, and the salary becomes taxable, it is always advisable to withhold taxes, pay such taxes to the government authorities, and issue them the Form 16, and necessary compliances should be done in India. The exposure of the company can still be taken care of in terms of how the work has been allocated, under whose supervision they are working, what are the parameters basis which the PE presence can be negated. But the compliances of the employees should be undertaken in India. The compliances should be kept completed in India, because that is something which is very relevant from the adverse, from saving from yourself from the adverse tax provisions. Next slide, please. Moving from the jurisprudence that we have seen off late to the jurisprudence that we have seen as latest as a couple of months back, this deals with the issue of NCDs, how they have been off late held as taxable, the interest on the interest payable on NCDs. This is a transfer pricing issue that we as consultants have faced for few of our clients. We thought it will be prudent to bring it to the knowledge of the people at large. And this is how the tax authorities nowadays are taking position. Therefore, we have to keep our wardrobes clear. We have to keep our documentation clear, because this issue may come up somewhere down the line, and we have to be aware about it. For this, I'll just request Atul to take us through the facts and how exactly what needs to be taken care in this issue.
Yeah, thanks, Saurrav, once again. So, with respect to the recharacterization of the NCDs, let me first allow me to explain the concept of this entire judicial litigation which may come up in future. So this may get attracted in case of Indian companies who have issued NCDs to their associated enterprises and are not paying interest to them, or are only accruing the interest as per the NCD agreement with the debenture holders. So in order to ensure that any transaction imbibes the characteristic of a debt, certain tests have been defined under the OECD guidelines. Otherwise, such a transaction may take the character of a equity. So there are about 13 tests which have been defined under the OECD guidelines, like to name some of them, like name of the instrument, fixed maturity date, obligation to pay interest, enforcement of payment, and NCD is not being subordinated to other creditors. So, in my view, the tax officer has no power to recharacterize a genuine business transaction, making it different from what has been reported by the company. So the scope empowered on the tax officer is to challenge the ALP and not recharacterize a genuine business transaction, making it different from what has been reported by the company. So the scope empowered on the tax officer is limited, and this has been established and supported by the judicial precedents in the case of Cotton Naturals India Private Limited by the Honorable Delhi High Court. So, accordingly, considering the aforesaid decisions of the Delhi High Court and various similar judgments by benches of the tribunal, uh, the tax officer, in my view, is not empowered to recharacterize a genuine business transaction unless the substance of the transaction differs from its form. So, for which the onus is on the tax officer and not the assessee. So this is a burning issue which may come up in the future, especially for those companies who are not paying interest on the NCDs, and the department is running or identifying such companies, and they are putting them into or bringing them on the table for litigation.
Right.
Over to you, Saurrav.
Thank you, Atul. Just to add, because it was me and Atul who were both engaged in this hot topic of defending our client. I think what is also very important to understand is the NCD as an instrument, the NCD agreement plays a very, very vital role. So the covenants of the NCD agreement should be well taken care of. The covenants should be stringent enough, and where there is an accrual that is happening and not an actual payment that is happening, such accrual should be backed by a document which shows the waiver. All these documents may not give you a relief at the initial stage of assessment or litigation, but definitely when this matter travels up in the forum of litigation, the relief is bound to be expected, and there these documentations play a very, very important role for us to take it forward. Next slide, please. I think moving from the tax jurisprudence and tax litigation to the transfer pricing documentation that is required to be maintained, I'll just take you over from the India part, then my colleague Linda will take you over from a Germany perspective. Next slide, please. So from an India perspective, when it comes to the master file, it is an annual compliance that needs to be made. The due date of course, there are certain thresholds and parameters which if breached are only the trigger point for maintaining a master file and submitting to the tax authorities. For a master file, there is a limit of consolidated group revenue of more than INR 500 CR. Then the transaction with the domestic and the local entity, that is the subsidiary, has to be exceeding 50 crore in terms of the rated party transaction. And these transactions have to be in the nature which are specified over, that is a purchase, sale, transfer, lease, or use of intangible property during the year, which exceeds more than 10 CR. If all these conditions are cumulatively satisfied, in that case, the master file requirement triggers. The master file has to be filed on an annual compliance, as I said. It is to be filed along with the return of income, where there are multiple subsidiaries or multiple entities in India, those who are transacting with the foreign entity. In that case, any one entity can be nominated, which can do the master file compliance. Rest all can simply file a notification, an intimation about the entity's name, which will be doing such compliances. This intimation needs to be filed 1 month prior to the due date of filing of the return of income. Then coming to the local file is more of a transfer pricing study that is required to be done on an annual basis. Yes, of course, there is a view that the transfer pricing study can be done, and if there are no changes in transaction and circumstances, it can be continued. Yes, definitely, it can be. But where the transfer pricing study is required to be done depending upon the threshold limits breached, in that case, the due date is to, since it is not required to be submitted, but it's required to be maintained. The due date for the same is specified as 1 month prior to the return of income by which the transfer pricing study or local file should be maintained and finalized. Next slide, please. From the certification perspective, the Form 3C EB is a certificate as a report of the accountant that needs to be obtained along with the transfer pricing study of the local file. This is again to be maintained, obtained 1 month prior to the return filing due date, and it is to be, this is a certification of the transactions undertaken between the associated enterprises are within the prescribed transfer pricing limits and they are benchmarked properly. Then CBCR is the country by country reporting, which has been which is a reason from the which has germinated from basically the BEPS action plan. As on today, the CBCR threshold limit is 6,400 crores, of course convertible to the currency to which it is applicable. The Indian entity may do the reporting of CBCR by being a surrogate entity, where the Indian entity is not a surrogate entity and not nominated by the foreign company, and the foreign company is doing its compliances in the local jurisdiction. In such case, the Indian entity is required to intimate the Indian tax authorities about the name and the duration for which such a CBCR is being filed. Such intimation needs to be given within 2 months, should be given 2 months prior to the end of the subsequent financial year. And where the CBCR compliances are required to be done by the Indian entity, then it is 1 year from the end of the financial year in which the compliances are needs to be maintained. Now, a very important point from a CBCR perspective, because we have been very actively engaged in the CBCR compliances and master plan compliances, is that the compliances once done, there's also need to do a checkup in terms of the risk, the assets, the functions that are otherwise disclosed as a part of a transfer pricing study, and how they are actually depicted in the CBCR forms. Because many times we have found is that the transfer pricing study continues from year-on-year basis. There might be certain changes in the group structure, there might be certain changes in the transfer pricing policies, and they are not updated in the study, but they might be reported differently in the CBCR form. So all these things needs to be cross-related, needs to be cross-verified, and basis this, a risk assessment needs to be undertaken and kept for the files and records. Because sooner or later the questions may arise to the from the department to understand when the CBCR forms or the information are being analyzed. Thank you so much. From this, I'll hand over to Linda, who will be taking you through the transfer pricing documentation from Germany perspective. Over to you, Linda.
Thank you, Saurrav. Yeah, let's go and have a look on the requirements for the transfer pricing documentation in Germany. Next slide, please. So in Germany, the tax auditors increasingly focus on cross-border transactions. Within the scope of tax audits, companies are therefore often asked by the tax auditor to submit transfer pricing documentation. Taxpayers may be obliged to prepare just the same three-tiered approach that Saurrav just presented, so including a master file, the local file, and as well the country-by-country reporting. So in Germany, there are specific local requirements for the transfer pricing documentation, which have been enacted already since 2003. Pursuant to Section 90 of the General Fiscal Code, the taxpayer must prepare the transfer pricing documentation concerning all cross-border transactions with related parties. Furthermore, the taxpayer must deliver supporting evidence for such transactions. Therefore, intercompany transactions generally have to be evidenced by written agreements in order to be accepted by the German tax authorities. Any agreement should be concluded before the respective transaction is executed. Besides that, for exceptional business transaction, that could be, for example, internal restructurings or the conclusion of long-term agreements, a separate documentation has to be prepared very timely, which means within 6 months of the conclusion of the fiscal year. Taxpayers who are part of a multinational group with total revenues of at least 100 million euros in the prior fiscal year are obliged to create an overview of the group's global business, as well as the system used by the group to determine the transfer prices. So again, this document is called master file here as well. So the master file shall include explanations regarding the organizational structure, the group's global business, the overall strategy for the utilization of intangible assets, and a general description of group financing. Next slide, please. Besides a master file, a local file is obliged for companies with cross-border transactions if the sum of remunerations for the delivery of goods or commodities from taxations with related parties in the prior fiscal year exceeds 6 million euros, or if the sum of these transactions exceeded 600,000 euros in the prior year. A transfer pricing documentation must also be concluded for the local file, and this should include general information on the organizational structure and the market analysis, the description of business relations with affiliates, a function and risk analysis, sorry for that, and a value chain analysis, a description of the transfer pricing method, and comparable data. So the local file is pretty much the same as the master file. It's just a focus on the German entity in this case. Next slide, please. Next slide, please. So as I said in the beginning, also a country-by-country reporting is needed, and this is to be prepared if the consolidated financial statements and the annual consolidated group revenue equaled or exceeded 750 million euros in the prior fiscal year. In some circumstances, the responsibility to submit the country-by-country reporting can be delegated to a group entity. Otherwise, it shall be documented by the ultimate parent entity. So overall, it can be said that the focus on transfer pricing is increasing in Germany. We would therefore recommend knowing the relevant regulations before working abroad and documenting them promptly and properly, because documentation afterwards is often difficult and prone to errors. Also, in addition to the transfer pricing issue, it should be noted that in Germany, there is a reporting obligation for certain cross-border activities. This is called the DAX 6 obligation. Whether a reporting obligation exists can only be analyzed on a case-by-case basis. So in case of questions, just give us a call and we can figure out if you have this obligation. Keep in mind that for both transfer pricing and DAX 6 reporting obligation, there are penalties to be paid in the event of non-compliance with deadlines or requirements. Yeah, so thank you very much from my side. I'm handing over to Saurrav and Atul, who are wrapping up.
Thank you, Linda. Thank you so much. Do we have any questions that have been asked to us that we can answer? Do we have time, Sanchita, in that case, to take up a few questions?
Yes, Saurrav, we can take up a few questions quickly.
Please.
And I can just immediately tell you about the questions.
Sure.
So the first question we have from the audience is, what are the tedious implications for making the reimbursement of the expense to a holding company?
Atul, will you take that question, please?
Yeah. So I'll take this. So with respect to reimbursement, this is a very sticky issue, and it has been under litigation for several companies. Even we are also experiencing the same with many of our clients, where any kind of reimbursement done to the holding company is subject to litigation, where the department alleges that it should have been the taxes should have been levied on that. So what we actually need to take care is that when we nomenclature it as a reimbursement, it should be a pure reimbursement. That is point number one. And it should be substantiated with some valid documents, with strong valid documentation, which proves that it is a pure reimbursement where we were acting as an agent on behalf of the group company and there are no markups linked to it. The moment you have any markup, or if you're not able to prove to the tax officer that there is no intent to make any profit out of the reimbursements, then it will be difficult to justify your position and the reimbursements may be subject to taxation in India. So it is to answer it in short, that your reimbursement should be backed by supporting documents where you have been acting just as an your group company was acting as an agent on your behalf, depending on the situation, whether you are reimbursing or they are reimbursing you. So wherever the ultimate expense goes and sits, that entity should have the valid document and the supporting evidences for those expenses, and there should not be any markup linked to it. Then probably there is a high probability that the expense will sail through smoothly.
Thank you,
Yes.
Atul. The next question is, what is marketing support service model and its pros and cons with respect to corporate tax and transfer pricing exposure? Whether permanent establishment exposure is there for such businesses?
You are on mute, Saurrav. You are on mute, Saurrav.
Sorry. Now, from the marketing support service perspective, the transfer pricing implications, I think we have seen that such models are generally a cost plus model. Now, where these are a cost plus model, in that case, whatever expenses that are being incurred for the services to be provided to the HO, those expenses have a certain markup that needs to be benchmarked depending upon the comparables and the type of activities that are to be taken care of. When it comes to the permanent establishment exposure, a mere marketing support service does not itself trigger a P exposure for a foreign company in India. However, what we have to see and what we have to carefully understand is that how are these services provided? Are these services provided by the Indian company while acting for and on behalf of its foreign company, or are these services provided by an independent in an independent way, where the Indian company is providing its technical inputs, Indian company is providing the way forward basis its own team and workforce in India? Where this condition is satisfied, there is no P exposure, but definitely where you are acting on behalf of a foreign company or on behalf of a parent entity, in such case, the P exposure will definitely exist and that needs to be taken care of.
Thank you so much, Saurrav. So the next question is for Linda, and the question is, what proof is required to get tax credit in Germany, which is withheld in India?
Yeah, that's a tricky question. Germany is very strict and very formal in this case. So if you want to have taxes credited in Germany, you should have a formal proof, like a written tax assessment from the financial authorities in India. So make sure you get this proof from the financial authorities. From my experience, it's very, very difficult to get these. So I know a lot of clients that don't even try to credit them unless it's a really high amount of tax.
Thank you so much, Linda. So the next question we have is, as per DTAA, interest is chargeable at 10%. So if a person lives in India and have long-term deposit in Germany, will TDS be deducted by a German bank?
So I think from a TDS perspective, whether TDS will be deducted by a German bank, I think Linda will be the right person to answer to it. But just to tell you from an India perspective, where a foreign national becomes a tax resident in India because of the exceeding the number of days presence. In such case, if you are a taxable resident, that is, you are becoming a resident, an ordinary resident, that is a term that we generally use. Your global income becomes taxable in India, irrespective whether it's from the foreign FD or it is from the from an Indian bank. In such case, if the German bank is withholding any taxes on such foreign fixed deposit with the foreign bank, that will be definitely available as a credit in India, subject to the domestic foreign tax credit rules. but it will be taxable in India because of your status being a taxable resident person. However, where you are a non-resident, because of a number of days presence criteria not being satisfied, and in case of a non-resident, the foreign sourced income is not taxable in India. You are only limited to taxation of your Indian source or Indian nexus income. In this case, there is no requirement to obtain a foreign tax rate on such income because it is not offered to tax in India itself.
Yeah, so from German perspective, it's most likely that the bank will withhold withholding taxes because they are obliged to do that. But you can speak to your bank if there is some kind of exemption order where you can put a proof that you are a resident in India to be taxed.
Right. Any other questions that need to be answered?
Yes, thank you, Saurrav and Linda. So the next one will be the last question. Due to the time constraints, we will not be able to take up all the questions right now. So in case you have any further questions, or in case your questions are not answered, I would request you to please write to us, or you can write directly to the speakers also, and they will get back to you over email. So the last question for this session right now is, which is the maximum allowable number of days of German employees for working in India, especially for installation and startup of plans to avoid Indian income taxation?
Yeah,
I
so
think,
yeah,
please, Atul,
yeah.
continue,
So
please.
so as per the DTAA between India and Germany, the permissible limit for number of days is 183 days. So the moment you exceed the number of days, your status as a residential tax residential status changes in India, and that makes your income, you as an individual subject to taxes, whatever income you are drawing as a source from India. So in short, the number of days prescribed is 183 days.
Thank you so much. Thank you to our speakers, Linda, Atul, and Saurrav, for answering all the questions. And now I would like to hand over to Ms. Sood for the closing remarks. Over to you, Sumati.
So on behalf of the Indo-German Chamber of Commerce, I'd like to thank the audience for attending today's session. Thank you very much, Linda, Saurrav, and Atul, for a very, very interesting as well as a very, very knowledgeable presentation as well as a discussion. To the audience, we will be sharing the video recording as well as the contact details of all the speakers and the presentation. So, and if you have any further questions to the chamber or to the speakers, kindly feel free. And with that note, I'd like to thank all of you once again for a very nice discussion. Thank you.
Thank you so much.
Thank you for having us.
Thank you.